All right, let's talk a little bit about stock dividends. So dividends can come in a couple different forms. As you've seen, a company can pay a dividend out in cash, but in lieu of that, they might pay out a dividend in the form of their own stock. So these are types of entries are a little strange. So I wanted to go through just a quick example of this. If you do these steps kind of in order, they're not too difficult, but you do have to kind of just, when you read these problems, you first have to recognize it as a stock dividend problem and then do a couple kind of calculations before you get to the debits and credits here. So let's take a look at this example here. Let's say it's March 18th. The board of directors of Decor Inc. declares a 2% stock dividend on its 20,000 outstanding common shares. The date of record is March 31st, and the dividend will be distributed on April 15th. The par value of the stock is $3 per share, and the market value on April 15th is $12 per share. Okay, that's a lot of information. The first thing that you're going to want to do here is you're going to want to, like I said, do a calculation to figure out how many shares the company's actually going to remit out here. Remember, no cash is involved in a stock dividend entry. We're just talking about the company just basically giving away additional shares to their existing shareholders. All right, so the first thing that we want to do here, and you'll notice I've laid these steps out here in this problem. The first thing we're going to do here is to calculate the number of shares to be issued. To do this, all we're going to have to do is take the 2%, or 0.02, which was a 2% stock dividend, multiply it by the 20,000 outstanding shares, okay? That was given to us in the problem. And of course, we get 4,000. Now, here's where a lot of people make mistakes. Sometimes they'll do that calculation, and they'll see the resulting amount there, and they'll put a dollar sign next to it. That's not what this is. What we've done here is just figured out how many shares the company is going to give away. 4,000 shares. So be sure not to make that mistake. So that's the first step that you have to do. Once you figure out how many shares the company's given out, then we're going to need to take that and put it into whatever the dollar value is. That's where the market value is going to come in. So you notice in the problem they gave us on the market value on the day these shares were distributed, and they said the market value was $12 per share. So effectively, we're saying that that's what it's costing the company, because if the company had to go into the marketplace and buy those shares back, that's what they would have to pay, right? $12 per share. Remember, the company doesn't set the price of their shares once it's out in the marketplace. So to put a dollar value on this stock dividend, how much it's really costing the company, they would take those 4,000 shares, multiply it by the market value of $12 per share. That's given to you in the problem. And the value, or cost, I should say, on this stock dividend is $48,000. So there's our dollar sign. So you first determine the number of shares being given away, and then assign a cost to it based on the market value. Once you have that, now you're ready to go do your debits and credits. So don't jump in to do your debits and credits until you have that number. Once you have this number, that number there is going to go as a debit to retained earnings, which is a little strange. Retained earnings is an equity account, isn't it? And we're debiting it here. We're debiting retained earnings by $48,000. We're effectively reducing equity by the amount of shares that were given away. And if you kind of think about that, that makes sense. All right, the next thing you're going to do is you're going to increase the common stock account. Why? Well, there's additional shares out there now, right? We need to record it. Now, you might remember from the earlier parts of the chapter where we issued new shares. We always issued the new shares of the common stock account at their par value, and that's what we're going to do here too. So the par value of the stock was $3 per share. We're giving away 4,000 shares, so 3 times 4,000 is 12,000. So we're going to credit the common stock account for 12,000. Remember, this is an equity account, so it increases on the credit side. Okay, now remember, my debits have to equal my credits, right? What's my difference here? I've got a $48,000 debit. I've got a $12,000 credit, which means that I need a $36,000 credit. That is going to go to the paid-in capital in excess of par. Paid-in capital in excess of par.